Good morning, everyone. Thank you ever so much for joining our webinar masterclass today, brought to you by Mortgage Brain. My name's Grace Teager. I'm the product owner for Criteria Brain and Affordability Brain, and it really is my great pleasure today to introduce to you our virtual event. This is our third mortgage masterclass now, so I really hope you do enjoy this session with us today. Today's masterclass is brought to you by CHL Mortgages, and I'm pleased to introduce you today's presenter, Ross Turrell, who is the Commercial Director at CHL Mortgages. Ross is going to delve into the topic of limited companies in the buy-to-let market. CHL Mortgages is brand new to Criteria Brain, so I'm really excited to hear all about their limited company proposition today. After the presentation, Ross will be available to answer any questions that you may have, so pop the questions in the question box at the bottom of the screen. And before I pass over to Ross, we always love to get your feedback from these events. So we will be sending you an email this afternoon, which will have a really quick questionnaire on. So if you do have 5 minutes to fill that in, send it back to us for any comments. That would be brilliant. It's always great to hear what you guys think. So yeah, thank you very much for doing that. I'll now pass over to our guest speaker today, Ross Turrell from CHL Mortgages. So thank you, Ross.
Hi, everyone. Can you see me? Right, let me share my screen. Okay, so welcome everyone. Pleased to virtually meet you all. My name is Ross Turrell, Commercial Director at CHL Mortgages. As you just heard, we're new to Criteria Brain, but as you can see, I'm not new. I've been around for a little while. Some of you may know me. I've actually been in financial services and the lending arena for about 35 years, 25 of those in the buy-to-let space. CHL, quick history about CHL. Some of you may know the brand if you're part of the grey hair brigade like myself, or no hair brigade. We've been around quite a while. Originally started in the 80s, a London-based lender, hence the original name Capital Home Loans. But moving forward, it was in the sort of late 90s that we really got established as a buy-to-let lender. We were one of the original buy-to-let lenders, along with the likes of Paragon and another company called Mortgage Trust at the time. So a lot of experience in buy-to-let. By 2007, the buy-to-let market had really taken off. We were busy. 2007 was a very big year. We were a top 20 lender at that time. I think we had about a £7 billion mortgage book, so fairly large. Obviously, it all went a bit horribly wrong in 2008. We had that thing called the credit crunch, which seems quite a long time ago now. And when I talk to the youngsters in head office that have just started, they're in their mid-20s, so they'd have been at school at the time, and they kind of look at me with two heads, wondering what the credit crunch was all about. But anyway, the credit crunch we went through, then moving forward, sort of today, we've still got a significant mortgage book, predominantly buy-to-let, about 4 billion. 30-odd thousand accounts. So we're still a fairly significant lender. And in terms of UK finance, in terms of their metrics, we would be classed as the top 30th lender in terms of size. So still fairly significant. But I think the important part was when we came under new ownership in 2015 by a company called Cerberus, so big American New York PE company. So 2021, we're back in the market. So from being a significant player to being a servicer of the existing book, we're now back in the market, and we relaunched back in 2020 in May this year, 2021. So in terms of where we are, what's the difference? What are we all about now? So as I said, we've got the significant back book. Throughout the period since the credit crunch, we've still been a significant player in the securitization markets and the capital markets. Every year we've been securitizing, so very active there And a consequence of that is we've still got in-house end-to-end treasury functions. So all the functions that you would expect to see from a major lender, and in particular the expertise that we've got in-house with the capital markets. Cerberus, very big operation, 55 billion asset value. Interesting, they're in a number of banks in Europe, very deep pockets, a very, very strong shareholder for us, which has given us very, very strong funding lines. But more importantly, I think from your point of view is, who's in the business, and we've got a lot of people in the business, still in the business. A lot of people returned to CHL who were previously working with us, and they've got the expertise within the buy-to-let sector. Quick sort of overview as, what are we doing back in the market? So who we're lending to, we'll lend to individuals and the limited company structures, and the properties that we'll lend on, the HMOs, multi-unit blocks, as well as the standard residential properties. We're a non-regulated buy-to-let lender, so that gives us a little bit more flexibility than some of our peers. But in terms of what we can do, we've got this. Should have turned my phone off. Apologies, everyone. My phone was buzzing in the background. Capabilities, we can lend typically up to £1 million. We can go over £1 million, subject to referral. So if you've got some of the big cases, particularly you guys and ladies that are more London-based, there will be some bigger properties that we can lend on, and we've done a number of those. Particularly good with portfolio landlords. We understand them. We've got many portfolio landlords still on our books. Very good market for us. Very good quality business. One of the key areas is the ICRs, 125% at 2.88. It's our lowest rate. So that works very well. All the 5-year products, as it says there, they're on pay rate. So far to date, I've not had any issues with the rent calculations working well. Interesting one, we've got high rate taxpayers. They're stressed at 140%, which is slightly better than some of the competition. Quick look there, the rental calculation. So fairly standard for 2 years, depending on the structure, whether it's an individual or limited company at 125 or higher rates at 140. And I said all the 5-year rates pay rate. So on to what we want to talk about today, and that's limited company lending. Just to a quick overview of limited company lending. It's nothing new, It's become very popular over recent years, but it's not new. Back in 1998, I was doing limited company lending, and I expect there's a number of you on the call today that have been doing business back then. In basic terms, what is limited company lending? Essentially, if you've got Joe Blogs Limited, we'll lend to Blogs Limited if we're happy with Joe Blogs. Happy with Joe Blogs, personal guarantee, off we go. So it's just the structure set up. Essentially, we're still lending to that individual. We're taking their personal guarantees, and as long as we're happy with the individuals behind the limited company, we'll lend to the limited company structure. So there's a number of things for you to consider when you're looking at limited company, and what is the reason? Why would your clients want to put it into a limited company structure? So I think you need to be talking to them about their strategy. What's their investment strategy, particularly long-term strategy, because there's a number of aspects that need to be considered. Is it purely to save on the income tax? You will see a lot of them will have had a bigger income tax bill of the tax changes of 5 odd years ago, or they're now coming in to full view now, and people will be paying more tax. Succession planning, that's an important factor. If you think about buy-to-let, I mentioned, buy-to-let's been around 25 years. Well, 25 years ago, the average, and probably still is, the average age of a buy-to-let investor, people in their 50s. So guess what? All those people 25 years ago, they're in their mid-70s. And a lot of them that have built up portfolios over the years, they build up a huge amount of asset value, and they'll be looking at a fairly hefty inheritance tax liability unless they do some planning. So there's a lot of opportunity in the market for that. So there's many reasons apart from just the taxation point of view. So, as I mentioned, the removal of the higher rate relief on the mortgage interest, that's one very, very big, compelling reason for people to put their buy-to-let properties and portfolio into a limited company structure. And we're finding it particularly popular with purchases at the moment. I guess you guys will be as well. The interesting thing is, with the corporation tax, you're looking at 19% at the moment. One thing to be very mindful is that corporation tax isn't designed for buy-to-let, it's designed for corporations, for limited companies in general. So, we may well see various tax changes over the coming years. There's one coming up, I think it's 2023, corporation tax will go up to 25%. So that will affect some buy-to-let landlords that are in limited company structures. A lot of them it won't, because there's a threshold of 50,000 profit for that to kick in. But a lot of different things that you need to take into account. We'll look at some of those now. Oh, bear with me. This is what happens. Unfortunately, today I was going to be joined by Daniel Watson, who's going to be doing the bulk of the presenting, one of our BDMs, but he's off sick with COVID, so you're left with me. So, one, I'm not so great on technology, and two, it's not actually my presentation. So, please bear with me on this one. So, limited companies, what are the pros for it? So, clearly the interest rate tax relief is at 25, is at the standard rate. So you don't get the higher rate tax relief impact with limited companies, whereas individuals would. Another big advantage, they can actually take dividends. Up to 2,000 is tax-free for personal income. And if you can have a number of shareholders on the limited company, which can all take the £2,000 dividend tax-free. There's no income tax when they're reinvesting the profit, so it's not personal taxation. It's all kept within the limited company wrapper, so they can actually control when the taxation is paid. One of the big advantages is if you think you buy a property, you put in your deposit, say 25% deposit, which is going to be on a typical property anything between 50 to 100,000 as a deposit. They can put that in. They don't have to put that in as share capital. They can put that in as director's loan, and then when they're taking the income from the rent, they can take that income out tax-free because it's repayment of from personal taxation tax-free. So there's a number of advantages with that. One of the main reasons as well, the people in the past prior to the tax changes would have looked at limited company structures. Two the main ones in my mind, and one is the fact that they can control when they pay tax by keeping all of the money within that limited company structure. And if they've got tax years where they know they're not going to have other income, they can draw the money out or dividends out or income out and control the amount of tax they pay. But another particularly in the buy-to-let market, another area that is really useful to them. And as I say, a lot of the older established landlords are seeing this, and that's succession planning. If you think about if you've got property and you've got to transfer those properties to sons and daughters, other family members, there's quite a lot involved in shifting the property and various tax implications. When you've got a limited company structure, those properties are owned by the limited company, and it's all about the share value of that limited company and the shares within that limited company. Far easier to transfer shares in between family members than it is to transfer the actual property. Bear with me one moment, schoolboy error. Let me just plug the laptop in. Is it me, or is the batteries just don't last very long these days? Okay, so in terms of limited companies, it's not all plain sailing. There is a bit of additional running costs in setting up the limited company, although it's not massively expensive. Typically £300, the solicitor will set that up for the individual. Running costs, yes, there are running costs of the limited company. But if you think about someone who's got a big portfolio, generally they'll be paying an accountant anyway. So the costs aren't massively more than what they'd be paying to their accountant without the limited company structure. Choice of mortgage rates, well, it's becoming a lot more common now, the availability of limited company products. A lot of lenders, including ourselves, don't load the rate for the limited company. So the rates are fairly competitive. And there's more and more lenders coming on board that are offering limited company lending. One disadvantage is you don't get your personal capital gains tax allowance when they sell the property. So that's something to consider if they've got a fairly small portfolio, only one or two properties. And just bear in mind, in terms of the legal costs, can be a bit more expensive because there's a lot more involved for the solicitor for the conveyancing. And one of the things that the most lenders will want is independent legal advice for the directors who are signing personal guarantees. And I think one of the message for you guys is, look, build up some contacts with experts in taxation. That's not just accountants. That's particularly tax advisors. Accountants tend to look back on what has happened. Tax advisors will tend to look forward on what's going to happen and how to mitigate taxation. And in particular, property tax experts. They're the guys that, if you can build and foster relationships with those, will assist you greatly. We're not experts on tax. That's the domain of other people. And I'm sure your compliance people will regularly tell you that you can't give tax advice. So this is sort of giving you a generalization of what it's all about. So another big advantage with the limited company structures is in the deposits, particularly on your bigger portfolio landlords. And you may start seeing a number of various structures. I gave you a very simple structure of Joe Bloggs earlier, but there's far more complicated structures where you've got holding companies, you've got subsidiaries, you've got specific SPVs that are, potentially wholly owned by the holding company that will hold the property. You've got trading companies. So with all those various structures, where is the money coming from? We're particularly flexible on that. We understand that they'll have money in the holding companies, they'll have money in other companies. They'll be putting money in from these structures into intercompany loans in particular. That can all be catered for. They'll have reserves in various companies. They'll have retained profits that they can use. And importantly, I mentioned earlier, the deposits from the directors / shareholders, and they can either be, directors. They can put money into the limited company. And bear in mind, with limited companies, everything has to be accounted for. Forget about gifts. If you hear the word gifts, you can't gift into a limited company. It's got to either go in as share capital or as loan. Directors' loans would be typically how it would be put in. So just bear that in mind. Needs to be done and all be accounted for. But there is the capability for that to be done, and there are a number of lenders that understand how that works. So this is if I've got a pound every time I get asked this, and you're probably the same, can I transfer existing properties into a limited company? The simple answer is yes, you can. The longer answer is it ain't easy. If any business can incorporate, that's a fact. To do that, you have to incorporate the business as a whole. And that means everything has to be done at the same time. So if you've got a number of properties, all those properties, the whole business would have to be incorporated at the same time. The HMRC is also very anti people who are part-time landlords incorporating. They want to see it that it's run as a business, as a proper business, and there are a lot of hoops that they've got to run through. That really is one for the accountants, good accountants, not just your bookkeeper up the road. Get a decent firm of accountants to get advice on that, if they can incorporate their current portfolio, because it's not straightforward. Generally what you've got is the existing portfolio. You've got your sort of semi-professional landlord. Because there's loans already on the property, they won't necessarily all go into the limited company at the same time. So if it's not incorporating the whole business, then it's a sale. That property doesn't get transferred. Forget about the word transfer. It will have to be sold to the limited company, and that will then incur the various taxation. So typically there'll be a capital gain tax liability. There'll be the stamp duty, as well as all the normal fees that go along with it. So keep that in mind. There is on there, you've got if you want to Google it, the Elizabeth Ramsey versus HMRC case. That was basically where Elizabeth Ramsey took on the HMRC and won, and she was able to prove that she was running it as a full-time business and that she incorporated at the same time. So it can be done, but you do need to get expert advice. So types of limited company, you tend to get two types. There'll be trading company and SPV, special purpose vehicle. Special purpose vehicle is literally a limited company that just does one specific thing that it's set up to do. And in our line of work, it's for properties. So with ourselves, we'll lend on the special purpose vehicles along with many other lenders. Day one, it can be an existing business or it can be a day one brand new setup, makes no difference. The key consideration for us is who's behind it. Are we happy with the people behind it? So the old Joe Bloggs scenario, happy with him, we're happy with the limited company. Doesn't matter whether it's brand new off the shelf with nothing in it, or whether it's an existing limited company. Trading company is slightly different. It's not so common because generally people will put their property into a specific vehicle. It just makes it easier to run and control. But you do now and again come across trading companies. What's more common, I think you'll find, is where you've got a trading company and then you've got a subsidiary. So they're using profits from the trading company and they're investing those into the property portfolio. One thing to remember, though, when you are dealing with the more complex structures is what existing lending or borrowing have they gone? What charges are already on that company? So typically, if they've got bank lending, the bank will have a debenture, which is effectively a charge on that company. There may be floating charges on that company. Doesn't mean it's not doable, but it just means that the solicitor has to do a lot more work just unraveling it and making sure we get first charge on the property that we're taking as security. With a limited company lending, as mentioned, solicitors, what I would advise is really make sure your choice of solicitor is one that has experience in the limited company space, because it's a little bit more complicated. They need to know what they're doing. It might be a little bit more expensive, but I guess you've all come across cases where people have used the cheapest solicitor, and it takes forever. They get things wrong and it doesn't happen quickly. So my advice is pick a good solicitor. On that, in terms of our solicitor panel, we've got an open solicitor panel, providing they've got at least 3 partners, or the registered approved person these days, isn't it? The PI of 2 million, and they need to be on lender exchange. So that's the key. Get them on, make sure they're on lender exchange, or they get onto lender exchange. We don't have a restrictive panel as to who can join our panel. But yeah, key point there is look at the solicitor, make sure you've got a decent one. So directors, shareholders, combination, we clearly every company has to have directors. Generally what we find in the property space, it'll be the same directors will be shareholders as well. Otherwise, why would you? We can cope with a maximum of 4 directors or shareholders on the mortgage. Got a minimum age of 21 for the primary applicant and 18 for secondary. The directors, or I should say shareholders with 20%, directors and shareholders with 20% or more shareholding will be required to give their personal guarantee. Reason being, they're the people with significant control of that company. Anyone with less than 20% shareholding, we ignore. Typically, it will be sons, daughters that they're putting on there for tax purposes and in succession planning purposes. We don't need to take their guarantees, and we don't need them to sign up on the mortgage. The one proviso is that the guarantors would need to hold a minimum of 75% of the shareholding. So again, we've got proper control over the company. Okay, so giving you a bit more info about CHL and what we're doing. Happy with experienced landlords. Do a lot of business with the experienced landlords, and we can still do first-time landlords as well. We won't do first-time landlords who are first-time buyers. Not our part of the market. Up to 4 individuals can be part of the application. Minimum age there, can go down to 18 for the secondary applicant, but typically 21 will be primary applicant. We will look at minor adverse. You've got the bit of info there. It's all on our website as well. But just in terms of adverse, we're dealing with buy-to-let investors. And just remember, that you're dealing with good quality people who've got money. If people are in trouble, generally they'll just sell a property. So our experience over the years is that generally there's no issues with the buy-to-let landlord. Typically the adverse tends to be minor. Typically, if you've got a utility bill that was at one of their properties they didn't know was owing, that the tenant doesn't pay or whatever, and they come after the landlord, we get that. We're not worried about it. We'll ignore them. So if you've got some minor adverse, give us a shout, speak to our BDMs. They're more than happy to discuss it with you. CCJs, obviously a bit more serious, but we will look at them. And fundamentally, the smaller the thing is, the quicker it was settled, the better. The longer the time period, the better. So again, speak to us if there's something you think there's a good deal there and there's something we should be looking at. Got the rates there. I won't dwell too much on the rates because they're likely to, well, they will be changing. So just give you a flavour of where we're at. Most of the business is coming in with ourselves on the 5-year fixed rates because the rent cover always works at the pay rate. So 75%, you've got 2.98 there. That's probably the most popular product that we're selling at the moment. And so say same rates for for limited companies as individuals. So HMOs, oh, done it again. Did I mention this wasn't my presentation? Let's just go back a page. There we go. HMO and multi-unit freehold blocks, do a fair bit of business with those. Again, the more experienced landlords tend to like them because they give good rental yields. So standard HMO, you've got your main definition there of at least 3 tenants sharing, forming more than one household, sharing all the facilities, etc. Where we go into the HMO pricing is actually when the license is required. So you've got your standard licensing across the board, 5 or more people. But you've also got the additional licensing schemes dotted around the country. So just be mindful of that. If you've got sharers, we're happy with sharers on a standard range. But if it needs a license, then it needs to go onto the HMO product. The multi-unit freehold blocks, again, they tend to be anything from 2 to 6 self-contained units that we're happy with. And again, they've always been fairly popular with the experienced landlords because generally if they buy a property that's got half a dozen flats in, if you had the individual flat values with leases on added up, they tend to get a bit of a discount buying the whole block. In my experience, 10 to 15%. So what that means is, when you're renting the flat out, the tenant doesn't give a monkeys whether it's a freehold or a leasehold flat. The flat is what it is, and it'll rent for what it'll get. It makes no difference. So they tend to get a slightly better yield on those properties, which is why they're proving popular. So for the HMO multi-unit blocks, we need at least 2 years landlord experience. Reason being, that you tend to have higher turnover of tenants, a lot more wear and tear, and they just need to have a bit of experience to know what they're doing with it. We can go up to 6 lettable rooms. If there's 2 kitchens, we're happy with that. Happy with student lets. Don't discriminate there. Values 150k in London South East, 100,000 elsewhere, and we can do either limited company or individual. Don't tend to get, it's got the ICR test on there, but we don't tend to get a problem with the rent cover on the HMO properties. By nature they're higher yielding, but we use the standard rent cover, so anything from 125%. And if it's on a 5-year at the pay rate. So as I said, just not getting any issues with the rent cover. So quick bit of criteria there. So it's fairly similar with the multi-unit blocks. Up to 6 lettable units we can go up to. Quick look at the rates, again, relatively competitive. Bit of advanced knowledge for you. We've got some improved rates on HMOs coming. Should be with us Friday. Don't tell anyone. So portfolio landlords, flexible underwriting for the portfolio. As I said, we've got a lot of experience in the buy-to-let space. We understand the portfolio landlords. And, throughout the credit crunch, where there's a lot of problems with a number of landlords had problems, we had very few problems with the portfolio guys. So really like portfolio landlords. Do a quick stress test in the background of the portfolio, 125 at 5%. If it covers that, then it's easy. If it doesn't, then we'll have a little bit more of a look. Generally, are the accounts showing that they're profitable? Have they got good experience? How long they've been running the portfolio? So again, so far since we started lending, again, not had any issues with background portfolios. We're happy with unlimited number of portfolios in the background. And you've got people ranging from tens of properties in the background to hundreds of properties in the background. We're very comfortable with them. Currently, we've got a maximum lending limit of 5 million, 2.5 million in the first 12 months, and then another 2.5 in year 2. So, bit of a recap then of what we do. Up to 4 applicants. First-time landlords we can deal with as long as they own property. Portfolio landlords, we like the portfolio landlords, as I mentioned. Limited companies, can be new limited company, can be existing limited company, can be a trading company, can be a subsidiary, holding company. We can cover all that. Student lets, we like students. Nothing wrong with them. It's not that we like students, actually. It's we like the landlords that run the shared accommodation. As I said, intercompany loans for the deposits. Happy with that. Happy with the complex limited company structures. Directors' loans. Gifted deposits. That's something that comes up from time to time. We'll accept, more than happy with gifted deposits from family members, so close family members. Not a problem. And again, generally it's utilised for succession planning. New builds, we'll do new builds, 70% on flats, 75% as standard on houses. Commercial, above commercial, we like property above commercial. Generally, it's experienced landlords that are buying that. You tend to have better yields on those properties. The only thing to remember, we're not going to do anything that's smelly or anything that's noisy. But other than that, then, we're happy with above or adjacent to commercial. The minor adverse, again, just a reminder, we'll do minor adverse. We're not going to get worked up on that. The shared accommodation, we can do shared accommodation on the standard product. If they need and not got any problems with the rental cover so far. So, if they do have to take the shared rental value to get the deal, then it'd have to go on an HMO pricing. But so far, I don't get any issues with the shared accommodation. And of course, that's popular with the landlords, improves the yield, where you typically have a 3-bed semi, you'll have 3 in the bedrooms, 1 in the dining room, and all of a sudden you got another a third more rent than you would potentially have had as a family let. Studio flats, we'll do studio flats, subject to a minimum of 30 square meters. Ex-local authority, doing a lot, particularly in London, where you've got high value ex-local authority flats. Deck access as well we'll do. Generally, you're looking at stuff that's the higher end of the value, particularly in London. Thing I always say on that, we've got that great tool these days, Street View. You can have a look on Street View, go and have a look round, tell me, are there any cars on bricks or graffiti on the walls or people walking around in hoodies with baseball bats? If there is, we ain't going to do it. But generally, if you've got, ex-local authority, good yields, and we like those. So give us a shout on those. And the last on that is something that we've done for years, for a few decades, and that's local authority leases. Again, they tend to be good, typically anything from up to 5 years. So as long as there's a break clause in there, then we can lend on the local authority leases. So a bit about ourselves then. We've got a decent sales team. They want to help. We've got the BDMs out on the road. We've got telesales in head office. We've got the broker support guys. They're all very experienced within the buy-to-let sector. They can help you. The case managers, you can get in touch with them. They'll speak to you directly. The underwriters will speak to you directly. Fully paperless, we're modern. DocuSign has become, the go-to solution. Got the online portal. Everything's online now. Apparently it's mobile compatible. I'm not the technical guy, so don't ask me. But it does, can use the system on your phone. With the instant dip, it's a soft credit footprint. And something we've put in as well is to help is the initial offer is valid for 4 months, can be extended by 2 months because that ties in with the valuation. So thanks for your time. And I expect if you've got any questions, fire them in and I'll be pleased to answer them for you. You're on mute. I can't hear you.
Oh, sorry, that's me. Now I'm struggling with technical problems. But yeah, thank you so much. Really, really good to hear from you. Lots of information for everyone there. And we've had loads of questions come in, so we will go through some of them. But if you've asked a question that we don't ask, don't worry about it. We'll email them all over to Ross afterwards, and he'll be able to get back to them. So a couple of ones here. Would you consider lending on a holiday buy-to-let?
That's a good question. And it's quite interesting with the last 2 years with COVID and lockdown and problems going abroad. There's been a lot of interest in holidaying at home, hasn't there? So we've seen a big increase in the interest in holiday lets. That is something that we're looking at currently. So at the moment, no, but it is something that we are looking into.
Brilliant. Do you lend to expats and foreign nationals?
Okay, so expats, it's really what we're defining as an expat. If it's someone that's literally moved lock, stock and barrel and they've gone abroad and they're living abroad, then no. If there's someone that is working abroad, and we seen a number of cases where you've got people, they're working in I don't know, the Middle East or whatever in certain industries, but they've got their home here, they're still domiciled here. This is their home. They've got their house here. They've got their credit footprint here. They're still showing a profile on the credit search. Then we can take a view on those. So those are an option. Again, expat, something that we're looking at, and we'll look at again early part of next year as to whether we expand the criteria on that. Foreign nationals, it's all down to where are they living. If they're living over here, and they've been over here for 3 years, so they've got a track record, they've got a credit footprint, and it's all, we can identify who they are, then yes, we can lend to foreign nationals. If they're foreign nationals abroad, then no, can't do them.
Cool. And we're actually running out of time, but like I say, we've had loads of questions come through, so we will make sure that we get back to you, everyone, with responses to those. And thank you everyone for joining today. It's our 3rd masterclass, so it's really great of you to see so many coming back to attend these sessions. As I mentioned earlier, the feedback questionnaire will be going out to you, and the event today will be uploaded to the platform, so you will have roughly 30 days to watch it back to go over any points that you wanted to rehear. Thank you ever so much to Ross Turrell for joining us today from CHL Mortgages. We really appreciate your time. We will be starting 2022 with another masterclass from Principality, where they're going to be talking about where home matters to everyone, so covering all sort of variety range of topics there. So hopefully we'll see you all there. But thank you ever so much for joining. Hope everyone has a lovely festive break, and we will catch up with you in the new year. Thank you.